Good afternoon, and welcome to the GENINCODE PLC final results presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Matthew Walls, CEO. Good afternoon, sir.
Thank you, Alessandro. Good afternoon, everyone, and welcome to the prelim report and accounts results for 2022 for GENINCODE. Paul Fulger is accompanying me here. We're in the centre of London at King William Street, for those of you familiar with roughly where we are. And we'll start to move through with some pace over the first few slides and then start to get into the meat of the presentation. And we'll try and give ourselves plenty of time towards the end to take some questions and answers from investors and those people on the call. So moving forward, I'll start with a quick review of a board. We'll talk through the highlights. We'll have a review of where we are in terms of product portfolio, the US strategy, which is key to the company moving forward, what's happening in the UK and EU, and then a little update on Roca, the acquisition we made through the past year, and then we'll finish on a financial summary and outlook. Board, no changes to report here, and we don't expect any. The board has been in place now for over the last year or two, post the IPO. We brought in Felix Frew more recently, who's based on the West Coast. Felix got a good background with the FDA, and he's been helpful in terms of supporting the work we've done on the 510K, which we'll talk through. And those perhaps who are less familiar with Hugh and Gray, who joined us, who headed up the cardiovascular side of the NHS here in the UK. Sergio Olivero, one of the initial investors to the company, and Bill Rhodes is the chair. And I think the group are hopefully familiar with the executive team too. Okay, so moving on, just in terms of a quick introduction. So GENINCODE, we're a clinical genetic diagnostic company focused in and around polygenics. So that's the use of multiple genes to identify, risk assess, and diagnose patients with cardiovascular disease. To do that effectively, the more complex it gets in terms of multiple genes, we have to use bioinformatics to do that. And increasingly, as we move forward at the algorithmic side of what we're doing, the risk scoring, we use an AI content too. So there are three effective parts to the way that we run through, report, and produce our results for our testing. We're revenue generating, albeit at the early stages of that process, but we'll talk through that in some detail through the presentation. We've got good regulatory positioning and increasingly now moving into the US. That's growing too. Solid investment in terms of the history of the growth of the company. And that goes back to the initial investment that was made by Ferra Grupo, the pharmaceutical company based out of Spain. Strong evidence base, and that's growing significantly and will do so over the coming months from the work that we're doing with Kaiser Permanente on the West Coast in the US. Got good IP protection around the core and the 4 products that we're now taking into the market. And that multiple product position means that we have a strong portfolio from which we grow, and we're growing out what we're doing in cardiovascular disease. The market is a significant market, and it's a big opportunity for the company. The reason for that is that at the moment, in terms of clinical risk assessment and the risk assessment of primarily globally at present, the way that a patient is assessed for the onset of heart disease and cardiovascular risk is by what we call clinical risk factors, whether you smoke, your weight, whether you undertake physical activity, and so on. I think most people on the call will be somewhat familiar with that. The piece that's missing from that is the genetic risk. And over the last 20 years, the one thing that's happened is that we've become now very clear that the genetics of the individual, the inherited genetics, is a key part and a significant factor. As a single factor, it's the most important factor outside of the age and gender of the individual that gives rise to the onset of heart disease. So to not include that, it's a suboptimal test process. So to include it is a key part, and that's what we do as a company. We bring the genetic risk assessment for cardiovascular disease to the patient population. So moving on to the report of the prelims, these went out on Tuesday morning. I won't cover them all in line for line detail, but just to give you a headline, because we'll be talking about these in more detail as we move through. We're now starting to launch our products into the US market. I'm pleased to say we've opened up our early access programs, and we'll talk more about that in a moment. We received our clear approval for setting up our new lab in Irvine on the west coast of the US. We received our PLA coding, so that's the forerunner to then receiving reimbursement. We've still got to go through that process, but we're well placed to move that through too. Final preparations for the filing of the 510K are in place, and we expect to file that over the coming weeks. We've been in the position of considering filing this for quite some time, but in discussions with the FDA, they wanted to see more detail in volume across multiple labs. So it's taken us longer than we expected, but we're happy about the progress and good communications with the FDA. So when we do file, we expect it to be right first time. So we're in a good position there, but it has taken us certainly longer than we expected to move forward. And just so the group are aware, this is on a kit format. It's not stopping us selling our product as a lab diagnostic test in the US, but it's the kit accompaniment to that. So it allows us to sell it much more broadly and in higher volumes as we start to move through the market in the US. We've also now had NHS adoption of lipid encode, so I'm pleased about that too. The last update I'd explained that there were budget issues with the NHS. Well, they're starting to move a little bit in our favour. So we've now not only started to receive budget for payment of lipid encode testing, but things are moving quite quickly on that front too. So we're pleased about that. We also talked about the launch of our first pilot for CardioEncode in Extremadura in Spain. So that's the rollout of the primary care process in Spain too. We also have talked about the launch of our programs now with lipid encode in Germany as well. So all of these pieces that are coming in now are revenue accretive, so building on the existing business that we already have. And whilst the numbers that we're reporting this year are not particularly high in terms of 1.4 million, we expect that through the deals we're now putting in place and announcing, this year we expect the revenues to double, or certainly move in that direction. And next year we're expecting to see them double up perhaps again. So significant revenue growth starting to come through now. And we expect to see some of that coming through in the interims as we report. That will be in September of this year. Kaiser is working very closely with us, and some of you may have seen some of the announcements we've made recently. We've got some big publications coming from them. Working with a big group like Kaiser, we have to, because this is a population-based testing we're dealing with. We have over 60,000 patients in the clinical studies that we're doing with them. And they'll be presenting this at the ESC annual meeting in the next couple of months. And we'll also be filing our first major publications with Journal of American Cardiology in the next few months too. So the big studies coming, big publications which show that the products that we're leading, especially CardioEncode, are very well placed for polygenic risk assessment of cardiovascular disease. They will be authoritative in the space. There'll be perhaps some of the biggest papers to be announced. They're based around a 15-year follow-up of patients on the West Coast within that population. So it's an exciting phase as the company moves forward. We also made, as I mentioned, this small and a very attractive deal for us as a company of the ROCA algorithm. This is for the onset and early staging of ovarian cancer in women. The importance of that work is that, and we announced this through the ALDO paper earlier in the year, this is the first product of its type to be able to see early staging and onset of ovarian cancer in women. As I mentioned, revenue's up marginally, but still coming through in terms of this at the early stages of our revenue growth cycle. And obviously we had a pretty solid cash position that we've measured over the last 2 years since we came to market. We've been very prudent around the amount that we invest. So we finished the year in 2022 strong cash reserves. At the moment, we have around about 6 million of cash. And obviously, we're keen to see the revenues growing now with a view to chasing down the losses and moving to a break-even based business model. Next slide. This is really around the regulatory position of each of the products within the portfolio. So on the right-hand side and moving from right to left, You can see we have regulatory approval across the European business. UK CA mark, we're still using the CE mark, which is accepted and will be until the CA process is set up properly in the UK. So we have LipidEncode and CardioEncode covered there. We expect into next year that ThromboEncode and SudEncode will also be part of the portfolio for the UK. In the US, CardioEncode now and LipidEncode are coming on stream, and we obviously have our filing with the FDA coming over the coming weeks, and ThromboEncode and SudEncode into next year as well. This is just a quick schematic for those of you not maybe familiar. We collect samples, either whole blood, buccal swab, or saliva from the patient. They go off to our lab. We process those on a molecular basis. They then go through our bioinformatics and AI algorithmic assessment, risk scoring, and we then produce those reports online to the physicians. So we've been operating in this way for the past 4 or 5 years as an independent company since GENINCODE was acquired and put together. And importantly, to do this effectively, you need a backbone system infrastructure to do that, which is what the CITAB system is. And internationally, as we roll out our products, we're rolling out the CITAB system with it. It's a very effective system, and it allows us to not only work through the products on a molecular basis, but also to provide that algorithmic AI and reporting online to physicians. So this is the market, slide 9. For the US, it's a significant market, not only in terms of numbers of Americans who suffer with cardiovascular disease, but the fact that it represents the biggest disease area in terms of mortality in the US. It's also a significant toll and cost burden, and is set to run out of, it's certainly almost run out of control over the coming years with the growth in cost associated with maintaining and handling cardiovascular disease. So this is, when we talk about cardiovascular disease, I'm talking about heart attack and stroke. And roughly speaking, that's 80% heart attack in terms of mortality and 20% stroke. Moving to the US, this is we're leading into the US with the 2 core products, CardioEncode and LipidEncode. We've recruited our own GENINCODE sales team now. So our partner, Eversana, who we've been working closely with, to complement that team, we've now got our own in-house executives. We recruited that team from the Vitae group on the West Coast, who are a fairly large diagnostic group there. The team has joined us at the back end of the year. They've been working very closely with us, and you'll see as we move through the presentation, we're now making good progress in terms of the team supporting the introduction of the products into the US market. In the first wave, that's the first quarter, we've now brought in 18 new accounts. So these are accounts that are starting to take our products, both CardioEncode and LipidEncode. And the early access program allows us to give them access to the product on a free of charge basis, and then in return for feedback and moving then on to adoption of the products moving forward. So we started this program at the beginning of the year. There are 18 in the first quarter. Just to give the group some insight, in the second quarter, we expect to double that. So there's a further group coming in the second quarter. And the likelihood is over the next year or two, we will continue. These are all tier 1 based groups, big institutions up and down the US, and I'll come to those in more detail in a moment. I mentioned on the regulatory side, we now have our CLIA certification and California state licensing. That allows us to collect samples from around the US, bring them back to our labs, process them, and provide the reporting online. And also the filing of the 510K is now preparing and near final in terms of submission over the coming weeks. We received our CPT PLA coding from the American Medical Association, and I'm also going to be presenting to the CMS in the next few weeks around our pricing for CardioEncode, which is the forerunner to our MolDX submission for reimbursement in the US market. Bearing in mind, again, for the group, just so you're aware, reimbursement represents about 20% of the revenue forecast that we have in our models. The other 80% is based on private payer-based insurance coverage. And it's important to get that reimbursement, but at the same time, start the discussions with private payers. So we've started the process with the CMS, and then towards the end of this year, we'll make the submission for MolDX. But at the same time, running in parallel with that, we'll be talking with the private payers too. As I mentioned, we're expanding the early access programs and the sales team. We've also appointed what we call a revenue cycle manager. The revenue cycle manager, for those of you familiar, allows us to the complexity of selling in the US. You're selling to clinical institutions, hospitals, consultants, insurance groups. There are a number of different pockets of sales and groups that we'll be moving product to. And in doing that, we do a lot of benefits investigation, prior approval checks, and so on. And to do that, we're working with a revenue cycle manager is a effective way of doing that in a complex selling process. So we adopted Synergy a few months ago. They've been working closely with us. They will be dealing with the US billing across those billing platforms, both in terms of CMS, reimbursement, as well as the private paying network. And publications, as I mentioned, just to finish off on this slide, strong positioning from Kaiser. We've also been asked, and I will be now sitting on the European Society of Cardiology's regulatory board, the Cardiogenomics board, around the introduction of polygenic risk setting for Europe. We've also been asked as a company to put together a roundtable for the American College of Cardiologists, again, for the introduction of polygenic testing in the US. Just so the group are aware, polygenic testing is a very difficult thing to do with. Very often, one of the issues is there isn't a lot of evidence base. We have perhaps some of the biggest evidence base in this area globally. And when we announce the Kaiser paper for a 15-year follow-up, we'll probably move, if not, we're already towards the front of that, to being at the forefront of change, both in terms of the introduction of our products, polygenic risk products, into the healthcare systems in Europe and the US. But we'll also be leading that with our products moving into market. Okay, so these are the cornerstone groups we're working with. So in Indiana School of Medicine, they head up our calcium scoring study. So this is a combination of using polygenics with calcium scoring. We know from the CT imaging calcium scoring that's undertaken, it's a point-in-time reference point. But coupled with polygenics, the risk of the individual in genetic terms brings another layer of insight and value to the physician in terms of risk assessing the patient for heart attack, heart disease, and stroke. Kaiser, as I've mentioned, they've done a lot of work with us over the last 10 years in preparing and running with CardioEncode in building it out, and they'll be presenting on that in much more detail later this year. There are actually 3 papers that we have, but the main paper, the first paper, is likely to be submitted a little bit about August, September of this year. MedStar, we haven't talked a lot about them, but they're going to be key and instrumental to what we're doing on the clinical utility for the filing of our MolDX program. They're based out of Georgetown, Washington. And NYP, perhaps the biggest of the healthcare groups in the US. So that's New York State, Columbia, and Cornell. And we're working with their primary care network in terms of introduction of CardioEncode to that group. So some really solid cornerstone groups who are now starting to take our product. And importantly, as we move through this process, they're also starting to use the same structures and systems that we've operated here in Europe and also with the NHS. So we're building out a system here that's common on an international footing. So here are the 18 sites that are the first tier 1 group that we're moving to. And you can see them. The interesting thing is in this second quarter, we're going to double on this again. So this is going to get quite a busy chart, but I quite like the idea of that getting very busy and lots happening. We're going to continue with this. It's a very mechanical process. So if I move to the next slide, you'll start to see how we operate it. So on the left-hand side, you have the list at the top, the first 18 in tier 1. We start with what we call a physician engagement or an education process. So we present our products to them, explain how they work, go through the reporting. They then sign up to an early access program, so they get a chance to use the products, test them through, get comfortable with them, and then they move on to clinical adoption. They're not working with us because it's a nice free of charge item to have. They're working with us because they believe these products will move the needle in terms of improving risk assessment in cardiovascular disease. All of these groups and most of the 18 that we work with, we've worked with them and they're knowledgeable about the products coming for the past few years now. So I'm pleased to say our expectation is that once they've been through the early access program, they've set up internally to start sending samples to us, that this program will continue to grow on an adopted commercial basis as we move forward. So it's an exciting time for us because that's just representing the first quarter. If you move on to add another 18 on the left-hand side, this program will continue to roll out in that fashion, at least for the next 12 to 18 months, as far as we can see with the tier 1 status groups. And then within each one of those groups, they have their own individual network too. So that cascade process should start to then unveil and bring polygenic testing at a cardiovascular level to most of the tier 1 groups. The tier 2 tend to be community-based, more diffuse clinic-based groups within states. And that requires a much broader bandwidth in terms of both cost and coverage. And at this stage, for what we're doing in terms of investment, we're keeping it very focused on tier 1, and we're using our CITAB system on a digital basis to move that system into position with these tier 1 accounts. So we're minimizing the amount of people and feet on the ground to keep the bandwidth tight, keep our cost base low, with a view to, as I said earlier, moving the company through to a break-even footing over the coming years. And we can see from the forecast side of where we are, we can see a pathway there forward to delivering that program. So again, I've put this in, I presented it previously in this format. I think it's a good way to keep coming back for continuity. We've started in the upper half of this slide is regulatory timeline. The lower level is the reimbursement pathway. So on the regulatory timeline, cardio obviously is earlier than lipid encode. Lipid encode is more advanced than cardio in regulatory terms. But in cardio, we've now launched the product into the US market. We've started the reimbursement process through the CPT PLA. We expect to file our regulatory submission for cardio encode. I'll be presenting to the CMS around pricing in the next couple of weeks. Towards the end of this year, we'll make our submission. And then into the beginning of next year, we expect to then see what we call the expanded launch. That's when we would expect to see the approval come through from the FDA, and that will then open up the kit-based process on top of our lab-based processes for cardio encode. On the reimbursement side, again, in line with what I've just said, the CPT PLA coding is now in place. Pricing is coming through. That then supports the MolDX submission. Early part of next year, we're looking then at, to some degree, we'd like to see the CMS look at it closely where we are. We'll have already started to provide product on a lab diagnostic test into the US market. So the discussions around CMS coverage will start in the first half of 2024. At the same time, in parallel with that, we're running out with our commercial payers. So we've started those discussions, albeit only at the 1 or 2 level at this stage. But this is important to us in terms of moving the product forward in coverage terms and reimbursement. It's also worthwhile saying that in these early days, once we move the product into market, we're working through an out-of-pocket self-pay process for the market. It's important that it's important for me and the company that we start to engage the product in the market. So self-pay and out-of-pocket, this is the means by which we price the product at a point at which an individual patient can pay for it themselves, is an important part of this first phase. It will be complemented by reimbursement as that comes through, but we don't want to hold up. We want to move the product into market, and where physicians are prescribing it and offering it to their patients and providing it at a price point for patients so they can afford it is a key part of what we're looking at now as a strategy moving cardio encode into market. In terms of the market, again, just to remind the group, the overall, there are 86 million individuals in the US who are suffering with cardiovascular disease, of those, 21 million are identified within that group of what we call low or intermediate risk of an event of heart attack or stroke. It's those that are currently in that 21 who are currently using, or they've used classic traditional measures to risk assess those individuals. So they're not using genetics. So when we did our market assessment with our partners of Asana, they identified that 8.5 million of those patients, when talking with physicians, if their patients had coverage, they would move them towards using cardio encode as a product. So there's a significant market for us to go to. The market itself is currently, in terms of the way that they're risk assessing that patient group, it's suboptimal. So that will be the first market position we go to. As you can see, it's a significant market. And for us, as we move into market, we expect to see that this is underpinning the growth of the product over the coming years. It's certainly not going to happen, immediately at those levels soon. It takes time to build out our network and the providers into the market. But it's a very exciting position. It's worthwhile saying there's 3 phases to that process. The first phase is introducing the product to physicians so they can start to prescribe. The second phase is that it becomes part of the guidelines, and that's what I mentioned a little bit earlier, and some of the early stage discussions we're now starting to have. And the third phase is, because the genetics of the individual represents 50% of the risk of them having a heart attack or event, then that will become the baseline. That will become the new key parameter that we're assessed by as we move forward in terms of risk assessment for cardiovascular disease. So there are 3 phases to the growth model that we're moving. Moving then on to lipid encode, so a little bit more established. Familial hypercholesterolemia is a little bit more advanced in terms of its position in the US market. But our product that we're bringing to the US market is more comprehensive and advanced than the current testing that's currently underway. So FH, as we call it, familial hypercholesterolemia, this is an inherited inability of an individual to metabolize properly cholesterol, which gives rise to elevated levels of cholesterol circulating in the blood, which therefore gives rise to the onset of atherosclerosis, clogging of the arteries over a lifetime. For those individuals who are identified as suffering with FH, then they're at a much higher risk of a heart event, heart attack or stroke, than those who have got a better metabolism for cholesterol. Now, the good thing about that is, once you identify the individuals, then it's a very effective mechanism for treating them. So it's a classic personalized medicine position, but we have to find them and we have to then effectively treat them. And at the moment, we both in the UK as well as in the US, not very effective at identifying these individuals. Last year, the CDC recognized FH as a tier 1 issue. So they've put it right to the top of the public health issues in the US. It's now got state coverage in 14 states in the US and reimbursement coverage from the private payers as well. So this is a good opportunity for us to move our globally leading product position into the US market. And the reason it's leading over what's current testing is underway in the US is for three reasons. First of all, we do a broad panel of testing on the FH side, which is roughly the same as what the testing is in the US. But in addition to that, we then provide polygenic risk assessment, which is novel. And then on top of that, we also provide the coronary artery disease risk, coronary heart disease risk, which is in addition to that. That's the CardioEncode piece, which is additive to that. So the physician gets a much more rounded view when he undertakes this test, rather than undertaking a test which is largely binary at the moment and carries quite a cost with it. So working on a binary yes or no and getting it wrong is an expensive process. So our product provides them with a lot more insight and positioning on the patient's risk for not only diagnosis, but then risk of heart disease in relation to FH and hypercholesterolemia. So we originally started at the beginning of the year and back end of last year with focusing on the tier 1 targets. And what we found is, as we had the discussions with them on FH and lipid encode, that they were all equally interested in CardioEncode. So hence we've accelerated CardioEncode. So both lipid encode and CardioEncode are now going into those tier 1 targets. The tier 2 targets, as we get deeper into next year, given the size and the bandwidth required there, we'll be focused on the tier 1 targets for quite some time. As I mentioned, we're already into growing that out significantly into the first half of this year. There are about at least 1.5 million patients in the US who suffer with FH. And the problem with that is, whilst it doesn't on the face of it look like a high number compared to cardiovascular disease, it's very difficult to identify those individuals. So whilst the overall market is perhaps in just taking the number of individuals who suffer with FH and looking at the reimbursement of around about $1,000, $1,400 a test, you come up with around about $2 billion as a market. very often it's based on a hit rate. So where at the moment individuals are being tested, here in the UK, we've just started working with the UK NHS, and in the NHS, the hit rate is relatively low. It's not a high number of individuals who they're proposing for testing who then turn out to be FH positive. So you end up doing a lot of testing where the individuals are not FH positive to find an individual who is. So the market size is actually significantly more than the 2 billion level that we've mentioned here, but just to give the group an idea of the size of the market and the offering we have. And this is the reimbursement for LipidEncode. At the moment, on a CMS basis, it's about $1,400 a test. That's Medicare, Medicaid. But when you then mix with that the private paying process, the aggregate drops to around about $1,000 a test. And we anticipate moving into market at a lower price to that. Here in Europe, just so the group are aware, we sell the tests for, in Europe, between 350 400 euro. Here in the UK, we sell it privately at £800 a test, or to the NHS at £450 a test. And in the US, we anticipate making price, we expect to be a competitive advantage for us as we move into the US market with what we believe is a globally leading product in this space. And again, as I said, it's a little easier on the regulatory and reimbursement pathway. We have the coding, pricing. We've now launched LipidEncode into the US market. Our billing will be, as I mentioned earlier, undertaken by Senegene. And it's really then into growth and adoption as we move through this year. And then again into next year, reviewing where we are in terms of an expanded launch. And again, then below that, it's primarily then working with not only the tier 1 partners, but also commercial private payers as we push them through on reimbursement on that side. So those are the two products, cardio and lipid. If I then move to the UK strategy, so this is with the NHS. We've talked previously about the work we've done. So we did originally clinical studies with the NHS, which were positive. We then moved into an pilot implementation in the north of England. And then at the last update I gave, I explained that the NHS was struggling to find budget to pay for the work that we were starting to do with them. Well, they've now found that, so we're pleased about that process, and we're starting to accelerate through the backlog of tests that they have in the north of England. And just so that the group are aware, that's the process. So on the left-hand side here, these are the 15 AHSN groups that are up and down NHS England. And we've been working with the North of England group. We've now implemented the process in the north of England. And just so, again, the group are aware, we've only done that in the past few months. The budget process has started to kick in, but already we're making good inroads for the north of England into that process. In addition to that, the same process we're now starting to unfold into other areas across the UK. So we're working with UCL Partners and Barts here in London, and also starting the process of working with the West Midlands too. So very exciting. The model's clear. We're also providing a product that is superior to the test processes currently undertaken. We're doing that in fast turnaround times by comparison with what the NHS can do internally, and also at a lower cost to the NHS. So it becomes very a simple and easy decision to make that it's better in this instance for the spend to be spent on the other more interesting areas of the NHS rather than not doing it. I mean, it makes more sense for them to move the business closely towards us, given we're providing a more comprehensive position, faster turnaround, and lower cost. On the EU, a little bit different in the EU. Each nation is much smaller in terms of size and scope and revenue, but we've got a good foothold and a good cornerstone out of the work that we've done in Spain, and that continues to be our key market in what we've done in Europe. Obviously, Italy is coming on board as well with that process through Spain, and recently we've announced what we're doing in Germany, which, coupled with the UK, we're seeing an uptick in revenues in Europe this year, so we're very pleased about that. Which, coupled with the German expansion as well, will mean Europe this year will have a pretty strong revenue performance, and you'll see that in the interims when we get to September, October this year. We expect to see probably in the first half, the beginning of a 50% growth year on year in the first half, but by the end of the year, we're looking at something in the order of about 100% growth in revenue terms, as I mentioned earlier. And then just a quick update on the Abcodia acquisition. The key point here is NICE guideline issues. So we're waiting for NICE to give a guideline update in this area. Ovarian cancer shares, there's a lot of overlap with the way that we look at early staging and risk assessment for cardiovascular disease. There's a lot of overlap with the way that the ROCA test performs for ovarian cancer. The interesting thing here is that the NICE guidelines, so this is for women who are suffering, they're high risk of ovarian cancer, they're BRCA carriers, and within that process, they've decided not to undertake risk-reducing surgery. For example, they've decided to continue with their family planning and not to have risk-reducing surgery, which is not that involves removal of the ovaries. So it's not as with breast cancer and BRCA1 and 2, it's not something that is a surgery that is easily undertaken, and therefore a lot of women will put it off. They'll think about family planning, and as a result of that, they then put themselves at higher risk. And what the ROCA test does is provide them with a monitoring tool for those women who decide not to go ahead with that, whereby they can monitor the onset and potential staging of onset for ovarian cancer. The important thing about this test is it's also got very good economics. So from a NICE perspective, it fits very well. But we're waiting for their guidance development on this. It will remain, as we are doing at the moment, it's a very attractive deal for us. We didn't pay any large sums up front or anything of that nature. But on the basis that we receive NICE guideline support, then this will not only move forward in the ROCA test, but we also have some interesting thoughts around earlier than the early stages of ovarian cancer, looking at the polygenic risk for ovarian cancer as well. So it's a good step for us to move in at a low-cost investment into ovarian cancer, into the cancer side, with what we do in preventative thoughts. But at this point, it's not one we're investing heavily yet, because we want to see that NICE guideline development coming through. Okay, I'll hand over to Paul, and he'll give us a quick update on the financials.
Thank you, Matthew. Good afternoon to you all. Just to recap, first of all, the company structure. So we have Topco, which is GENINCODE PLC. We have the main trading subsidiary historically, GENINCODE SLU, based over in Spain. We have GENINCODE US Inc. over in the US, and now we have the Abcodia company underneath Topco, together with its two subsidiaries. So we came to market in July 21, raised 17 million gross, 15.3 million net. So revenue's up 24% to 1.4 million, a modest increase, but real importantly, proof of commercial transaction. Geographically, as you can imagine, most of that revenue came from Spain. About 1.2 million of that revenue came from Spain. The rest came from Italy, £150,000 or so, and for the first time we had a small amount of UK revenue, about £36,000 of UK revenue. So far this year, in the first 4 months of 2023, we're around 30% ahead of where we were this time last year. So good solid growth, and that was helped by £40,000 worth of UK revenue in April, and hopefully at least £40,000 per subsequent month for the rest of the year. So Matthew discussed the interim number there. We expect to be 50% ahead of where we were last year, and hopefully by the end of the year, with that solid UK growth, we should be double where we were last year, and potentially and hopefully double next year as well. Product-wise, Lipid Encode is up 30%. That represents almost half of our revenues, so that's our biggest seller. Followed by Thrombo, followed by Sud Encode, and followed by Cardio Encode. Now, Lipid Encode and Sud Encode are the two sequencing tests rather than the genotyping tests on the other two. So they're the lower margin, so that's why the margins reduced down to 44% or so, because of that product mix. Notoriously competitive in Europe, so we don't expect margins to be above the 50% level really in medium to long term, and that's really by improving the economies of scale from the increased testing in the future. But product mix-wise, or geographic mix-wise, going forward, the UK margins will be much better. They're about 60% plus, and in the US, even better still, 70% plus. So we will see a blended improvement over the coming year and into the medium to long term as well. Operating loss increased to 5.9 million. The main reasons for that is two main reasons. Firstly, Eversana costs increased. Eversana, remember, is our US commercialization partner. So because we are close to commercialization, we've now geared up our staffing levels. So we've now got 5 full-time staff in the US. We've now got more or less 5 full-time consultants in the US as well. So they're a combination of lab staff as well as commercial staff. We've now got 2 labs, one in Hammersmith in London, in the UK, and one in Irvine in California in the US. So the starting costs, setup costs for kitting those out with utilities as well as equipment added a relatively significant cost base there. So we spent well over £1.2 million just on the equipment. But that equipment is obviously investment for the future, and that should help us scale up and for the next 2 years at least in terms of our testing capacity. So all in line with budget. On just 2 notable points on the working capital. So payables increased. That was mainly because of the Eversana deal we have last year to defer 50% of the costs. But because we haven't spent so much with Eversana, as Matthew mentioned, we've got some of the Invitae staff on our team now. So we have actually got our own, some salespeople ourselves. So we are saving significant amounts of money by Eversana not feeding us through those costs. So we're actually using some of those savings to pay down a little bit of the Eversana deferred payables now. And actually the Eversana deferred balance is a little bit lower than it was at the year end. We also have some equipment creditors at the year end and lease liabilities with changing IFRS 16 regulations, etc. Coming down to cash, we had £9.7 million at the year end. So on average last year, we had a monthly burn rate of about £400,000. That has increased, as you would expect, this year up to more like £700,000 per month. That's because we're closer to commercialization, so we've had to gear up our operating costs accordingly. But we're now around, we still have a good amount of cash. We have at least £6 million. So that's expected to last us well into Q1 2024. That's about it. I'll hand back over to Matthew.
Thanks, Paul. Okay, so just starting to round up a little bit, and then we'll move to some Q&A. This is the summary then of our key events looking out and news flow to come. And just drawing the attention from a left to right process. So we've now got our Clear Lab and California state licensing. We've now got our PLA. We've implemented the first NHS piece, and that's now started to grow in terms of revenue. Similarly, we've started to grow out what we're doing in Germany. That's also starting to generate revenues. So these are the incremental pieces adding to the interim profit or interim reporting position that will be coming back to the markets in the next few months. And we've now obviously started our early access programs in the US too. And then carrying on, we've got the filing. We've got updates from Kaiser coming, updates from MedStar. I'll be talking to the CMS, as I mentioned. We expect CAP accreditation probably into the 3rd, 4th quarter. I've got discussions ongoing next week on that side. And the CAP, just so you know what CAP accreditation is, of the 52 states in the US, some of the states, New York State being one, require us to have a higher level of College of American Pathologists coverage accreditation as opposed to just a clear. So it's a few additional states want us to have a higher level. We should have that in the next few months. That allows us to start bringing back, rather than testing in those states for the work that we do, we can bring those samples back to the Irvine lab in the short, medium term. MolDX submission towards the end of this year, and then expansion again into 2024. So those items in red, dotted in red, if you can see those, are all part of the recurring revenue streams now that are coming on board. And importantly, are driving through, have started now in the first half of this year, will impact the interim results and obviously push on into next year as they continue to grow out, especially the US and the UK, and obviously Germany as well. So all of those are starting to come through. So we're pleased about that. And then as we move to just, again, finalising and rounding up, all of the guns now are pointing out revenue growth. That's key. We want to start to turn the business now into a revenue generating machine on all of the products. We're now gaining regulatory approval so we can start to sell them in the key markets that we focused on. We'll be pushing on with reimbursement, filing our 510k kit, expanding what we're doing with the NHS, and moving forward, we're also looking at moving forward CardioEncode into the NHS as well. That will be important for primary care purposes, so we can bring the NHS alongside LipidEncode up to speed with what CardioEncode can offer as well. We'll expand the German collaboration too, and ditto the same with our Spanish and Italian collaborations as well. Towards the end of this year, beginning of next year, we'll look at then the commercial marketing team, because there will be, whilst it's not significant headcount numbers, there will be some step up simply because the sheer numbers of clients and we will have at that stage will be significant, and there will be some people who will need to have focused on the geography, mainly in the US. And as I said, we'll await then the NICE guideline feedback. And all in all, this is the final point, just to be clear, we're going to target, and this is partly as a result to take more and more, less and less reliance on investment and more reliance on driving the company into a profitable break-even profit position. That's where we want to be in the medium term. So that's the strategy for the company moving forward. Whilst we raised back in 2021 2 years of funds, we're now making it move to 3, stretching that, but at the same time making sure we deliver a formidable model from which investors can take comfort. So that's where we are. I think if I hand back to Paul, have you got the questions there, Paul, or is it Alessandro who's got the questions?
Yeah, no, we have a couple of questions up on the Q&A. Alessandro, is there anything you wanted to say first before I move on to?
No, so Matthew, Paul, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. So just while Paul and Matthew take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. But Paul, at this point, if I could just hand over to you just to chair the Q&A, I'll pick up from you at the end.
Yeah, we just have a couple of questions from Steve at this stage. Steve's first question is, with the increased levels of investment in the commercial program, when do you anticipate this turning from investment to growth?
Well, let me just try and understand. I think what he's probably saying is, when does he expect it to be no further investment requirement, maybe. In terms of growth, if we're talking about growth in revenue terms, then that's started. So that's the first point. From the beginning of this year, whilst it's been a bit difficult for the past few years with COVID and other things, we're certainly seeing this year an uptake, which is great in terms of the European business. Obviously, the NHS coming online is additive to that. Germany is additive to that, and the US, which is the biggest piece. We're now starting our early access programs, which we've just talked about. So growth has started. In terms of then the second part of that, which I think was Steve's question about when would we see that we don't require any further investment. Realistically, I think we're looking at forecasts that would turn us towards break even and profit in about 2 years from now, 24 months. That's based on our internal forecasts, to give you an idea. So yes, in the future, we'll be looking at investment, but this is likely to be the last round, this next round. That's our intention. I don't know whether that helps, Steve.
And I guess in terms of investment, we don't mean development investment, because everything has been developed. It's more about the clinical studies and the investment in the labs and the equipment and the people, which is what we have been investing in over the last couple of years. Steve's second question is, the US opportunities look very good. How do you see this scaling within LipidEncode? And what can we expect to see as a sign of market penetration?
So the first, let's go slightly in reverse then. The first sign of penetration is we want to see some good revenues coming through as quickly as we can. But we've got to be realistic as well. So we'll see the US generate revenues this year from LipidEncode, and we expect CardioEncode also to have revenues this year, even though obviously it hasn't got reimbursement in the same way that LipidEncode does. So we've led with LipidEncode. The pull-through has come for GENINCODE as well. So the two, to some extent, I quite like the idea that they can complement each other in terms of selling in the market. It's much easier to go with two products as an offering. So we will see that revenue coming through. In terms of then the first half of your question, in terms of how are we doing that mechanically, it's like I said, the first quarter of this year was driven by beginning the tier 1 access programs, early access, and that started. So we've had a really good hit. And I know that in the second quarter, it's similar. And we'll continue to run that mechanical model out. I like the idea of talking to the new clients, explaining to them what we do, and I'm spending a lot of time in this process with the clients. And of those clients, just so you know, they're slightly different shapes and sizes. Some of them we're looking at big contracts with them, or bigger contracts to move to commercial phase. Some of them are quite happy to order on the back of they're starting to use it and they want to buy more of it. So there's a little bit of value and benefit in that. Not everything has to have a big mechanical, heavy contract wrapped around it. For us at the moment, as we move product into market, so penetration, sales revenue, and growth year on year are the key measures, Steve.
Next question is from Andrew. Andrew asks, do internal budgets and forecasts show that there is enough cash to get to a cash positive position, or is a further capital raise envisaged? So maybe I'll kickstart that one, and Matthew, maybe you can add. Our current plans are that we will break even in 2 years' time, as Matthew mentioned, I think, a little bit earlier. And on our trajectory, we will need to do another raise between now and then. We could cut costs severely and change our strategic approach, and probably could make that without a cash injection. But I think the right way of doing it is to do a further raise between now and then. Did you want to add?
Yeah, no, I think that's fair. I mean, the other point to say is that we're also driven by not only running the business and driving it forward, but we have to keep an eye on where the financial markets are. And when we drew down the funding 2 years ago, we said we would raise money for 2 years, and at the moment, so the expectation was that maybe the markets would be still open for business. It's difficult. The markets are not. So we obviously keep an eye on that process. But at the moment, we're busy. We're busy finishing and delivering and moving our products into market, generating that upside on revenue, and positioning ourselves so we're in the best possible shape when we do decide to invest. But it would be, as Paul said, we've got to be realistic. We've got to raise sufficient funds when the time is right, to make sure that the business gets the break-even and profit position. But on the way there, there'll be plenty of indicators and performance measures that will show that the revenue and the top line is growing healthily and in the right direction.
David has asked the question, with further fundraising probably in 2024, many small investors will be discouraged, as equity fundraising will almost certainly be at a discount to the then share price. So again, maybe I'll kickstart and Matthew can add. Maybe not. We have some very, very positive news coming along. Matthew mentioned the submission of the FDA filing, and obviously the results of the FDA filing. I think that presents a couple of enormous opportunities for investors to get in at a price which we think is, you would expect us to say, very much undervalued at the moment. And all market indications are that there is an awful lot of value to be had from GENINCODE. So yes, maybe, but we expect not. So whether you wanted to add?
Yeah, I mean, again, we have to drive the business, generate against the plans we've set, make sure that we hit those revenue targets, and present the business in the best possible light, given the conditions on the financial markets. But we can't do much about that. The sector, the industry, technology, and small cap stocks are not in favour, and therefore we have to move with that, rising and falling tide. But no, there is a lot of good news and things happening in the company. I'd like to believe that was commensurate with the share price movement upwards, but it doesn't always happen like that. So in the meantime, we keep very focused on what we need to do, and the intent is to continue to build and drive real value in the company offering, so that from an investment perspective, whilst things are down, and we're obviously very aware of that it will recover significantly.
And David has asked a second question. Is there an alternative to equity fundraising at a discount, such as finding a cornerstone investor? And yes, the answer is clearly yes. We have a very supportive investor base at the moment, and we would fully expect those to continue supporting us and cornerstone fundraise as and when we do that at the right price as well.
Yeah, I mean, as you might expect, we're considering, and as we move closer to an event like that, we'll consider lots of different things. But yeah, it isn't only one way, one route, one back to the capital markets equity raise in the way that traditionally maybe that was done. We are thinking about things in a different way. There is a good thing that a lot of what we're doing in activity is US based, so that's helpful too. So that kind of perhaps opens up other opportunities. And yeah, we may have to think smartly about how we go about it. But one thing we're very fortunate to have is some very solid, supportive, strong investors. We stay very close to them. I try and keep them updated as fully as we can. We've obviously got a day job to do to run the business, but I think all of our investor groups that have been party to the journey we've been on so far are fully aware of where we are, the delivery of the company, how we're operating. But yeah, so we will consider many of those channels and different opportunities as we get closer to a funding event.
And Roger has asked a question: if you run out of cash Q1 24, I assume you will have to come to the market Q3 or Q4 this year. That's what our current plan suggests, Roger. But you know, as I mentioned earlier, our cost base is quite flexible. We don't have any big fixed costs that we cannot do anything about. So we can dial the cost expenditure downwards to extend the runway if we so wish. But wouldn't be exactly in line with our strategic plans. But that means that we have got a little bit of flexibility as to when we want to do that.
Yeah, I mean, you know, we run the business and we run it really tightly and keep it really, as you know, minimally in terms of the investment to keep our runway and cash position as strong as we can. But as you're starting to lift off, as you're starting to move and the revenues are starting to go in, what you don't want to do is start to go in reverse, because you've got, you know, thought process. At the same time, we have to keep an eye on that. So our preference is to continue to get air under our wings and move forward with a sensible raise when the time is right. But we have quite a lot of things that we've got to deliver between now and then. And we're on with that at the moment. So no, I think we're pretty well placed. But yeah, it's a fair point in terms of thought process. But you know, I don't think I want to be too specific just yet as to the exact timing.
Thank you. That's it as far as Q&A. Hand back to you, Alessandro, for a wrap up.
Yeah, Matthew, Paul, thank you very much for that. I think you've addressed all those questions from investors. And of course, the company will review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Matthew, could I just ask you for a few closing comments?
Yeah, thanks, Alessandro. I haven't prepared anything, but just to simply say to everyone who's followed and come onto the call, thank you. You're clearly interested in what we're doing. Please keep your ear to the ground and follow us as we move forward. We're in an exciting period. It doesn't necessarily, as I said, reflect that in the share price, but I think at the same time, you can be rest assured that there's a lot happening at levels at which, in terms of what we do as a company, whilst we're very small, we're working with big levers in the US and the European market. And I expect us to see significant growth over the coming years. So I hope we've given enough insight to that, and we've set out a plan that you understand and is clear. If it's not, then please reach out to us. I'm more than happy to follow up with you individually. But thank you for your time today, and yeah, please stay in touch if you want to follow up with us.
Matthew, Paul, that's great, and thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of GENINCODE PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.